shilling against the US dollar, coupled with the rising food and energy prices, have worsened the inflation outlook since April 2022 forecast round. Higher business costs are likely to spread into consumer prices, thereby pushing inflation higher in the coming months. Consequently, the annual headline and core inflation are now forecast to average 7% and 6.1% respectively in 2022, which is higher than the earlier projections. Inflation is projected to peak in the second quarter of 2023 before gradually declining to stabilize around the medium-term target of 5% by mid-2024. The inflation outlook is significantly uncertain, with the balance of risks tilted to the upside. The main upside risks include: 1, the global inflationary pressures amidst persistently higher world food and energy prices. The Russia-Ukraine conflict continues to strain supply chains and stoke international commodity prices. Secondly, a stronger tightening of monetary conditions by advanced economies aiming to control inflation could intensify portfolio outflows from frontier markets like Uganda, thereby further weakening the shilling exchange rate. Thirdly, higher prices in the global markets that would further increase the demand for foreign exchange, here US dollars in particular, will be required to purchase the same quantity of goods, and this could further weaken the exchange rate. Trade restrictions by some countries and stringent containment measures against the new COVID-19 virus strains in Asia are worsening the disruptions to the global supply chains. The downside risks include: 1, a much weaker domestic demand as higher inflation squeezes consumers' real incomes, together with tighter financial conditions which will constrain investment. And secondly, bumper food crop harvest could also lead to lower food prices. The adverse global economic developments and higher inflation have diminished the prospects for domestic economic growth. The optimism for economic recovery in January 2022 has been dampened by the effects of the Russia-Ukraine conflict. The Composite Index of Economic Activity, known as the CIEA, a high-frequency indicator of economic activity, is signaling a slowdown in the pace of economic recovery. The growth of the CIEA declined to 0.8% in the 3 months to April 2022 from 2.4% in the 3 months to January 2022. Economic growth is now projected in the range of 4.5 to 5% in 2022, which is lower than the previous projection of 5.5 to 6% as of April 2022. Weaker external demand, coupled with surging commodity prices and the resultant high domestic inflation, will lead to tighter monetary conditions, thereby constraining aggregate demand. The risks to growth outlook, which are tilted to the downside, include weaker global growth, escalation of geopolitical conflicts, persistent global supply chain disruptions, heightened economic uncertainty, and higher inflation. These downside risks are dampening consumer confidence, heightening exchange rate volatility, and prolonging weak growth in the private sector credit. Nonetheless, in the medium term, the economy will grow at 6 to 7%, supported by public and private investments in the oil sector. While the inflationary pressures are likely to be temporary, the worsening economic outlook, uncertainty, risks ahead motivated the MPC to tighten monetary policy to contain demand pressures until supply catches up. Accordingly, the MPC has raised the CBR to 7.5% and maintained the ban on the CBR at plus/minus 2 percentage points. The margins on the CBR for the rediscount and bank rates remain at 3 percentage points and 4 percentage points respectively. Consequently, the rediscount and the bank rates are now at 10.5 and 11.5% respectively. The Bank of Uganda will continue to raise the CBR until inflation is firmly contained around the medium-term target. Also, the Bank of Uganda will phase out the remaining targeted credit relief measures for the education and the hospitality sectors on 30th September 2022. Similarly, the COVID-19 Liquidity Assistance Program, known as CLAP, for managing potential liquidity risks arising from the pandemic, as well as the restrictions on the payments of dividends and other discretionary distributions of supervised financial institutions, expired on 31st May 2022. There ends the monetary statement for June, the monetary policy statement for June 2022. Thank you very much.
Thank you, DG. Thank you, DG. Now for the Q&A session. I will be stating your first name, and then you will introduce yourself, and then you ask the question that you want to ask. Are we ready? I asked the first, let me see. Okay, we are. Okay, Samuel Setumba.
Thank you, Charity. Samuel Setumba is my name. Happy to see you virtually, all of you, including the DG. A couple of questions. Thank you for the presentation. To the DG, sir, does the fiscal side, can the fiscal side help in this situation? Because monetary you are going to raise until inflation is reined in, but it has its own effect. So that's the fiscal. The other question is, what advice then would the bank give to business and economic actors or players as things unfold like this on several fronts, exchange rate and so many other areas? So what is the advice would you give to economic players? And finally, the expiration of the liquidity assistance and other restrictions by central bank due to COVID, can we say that banks can now give dividends? Is the central bank saying banks, you can go ahead and give dividends? Want the clarity? Those are my questions.
Okay, thank you very much. That is Mr. Setumba.
Samuel Setumba.
Yeah, thank you very much, Samuel, for those three questions. I will just give the bigger picture, and then the details will be given by Adam, who is the Executive Director of Research, and then Robert from the Supervision Directorate. In as far as the fiscal is concerned, I think it is a government intention to undertake fiscal consolidation. In this case here, it means that they will be supporting in terms also of containing aggregate demand. But of course, it is the distribution, it is the composition of that expenditure which is very, very critical. To what extent is it going to increase the supply side? Because the kind of inflation that we're dealing with here is really a supply side driven inflation. So while the government is undertaking fiscal consolidation, which is really very helpful for containing inflation, it is the composition of that expenditure towards.
There's some network issues. We are not able to hear the answer, sir.
Can I start afresh? All right. Sorry. I'm very sorry about that. I understand you had some, some issues to do with the connectivity. But I was saying that in terms of the fiscal side, it's my understanding that government is planning to undertake fiscal consolidation, which is expected to, to contain aggregate demand overall. And this is contained in their projections for the coming years into the medium term. Now, what of course will be important is what is the composition of that expenditure. If that expenditure is geared towards increasing the supply side of the economy, then that should actually go a long way in further reducing the challenges that we're having with the current environment that is leading to these high prices. So a reduction in the fiscal deficit with expenditure tilted towards increased supply should be able to help us with the fiscal, with the current economic conditions. And then your second question was to deal with the payment of dividends. I think I did make it clear that the restrictions on the payments of dividends and other discretionary distribution of payments by supervised financial institutions expired on 31st of May 2022, which means that the supervised financial institutions can now pay out their dividends. And I think that was the third question.
Advice to business and economic players.
Yes, advice to business and economic players. Again, like I did mention earlier on, the inflation that we're having right now is a supply side driven inflation. So I think we all have a role to play, that we need to ask ourselves, how are we contributing to the increased supply of goods and services in the economy? Right now, we are having high food crop inflation. So how can our population in the rural areas take advantage of the high food crop inflation and also earn income for themselves? And of course, if the opportunity to substitute locally the imported goods, then that should also help us in terms of raising incomes for the local businesses, while also increasing the domestic production and reducing the demand on imported goods, and of course the pressures on the exchange rate. But again, I want to emphasize here that this is where we can have local substitutes to imported goods. But in case I've missed out some things, I will invite Adam and Robert to chip in.
No, I think you have explained. Probably what I can add on is one simple thing, is that what we are seeing now on inflation is temporary. So it could be within this year, as the governor said, by 2023, we expect that inflation would have peaked to start declining. So the measures being undertaken today, increasing CBR, it is just saying, yes, we are seeing that this environment is temporal, and this is the only way to make adjustment in terms of demand to ensure that the demand meets the current supply, so that inflation doesn't continue increasing. So in terms of business, therefore, advice is to say, well, this is a temporary phenomenon. We shall go through it. But again, we have to look at our expenditure profiles across the board, both at household level and, as the Deputy Governor said, to see where we can make substitution so that the impact in terms of household income is not completely overwhelmed by the expenditure pressures we are seeing already in the market. That's what I can add on at the moment. Thank you.
Thank you very much. I will speak on the issue of payment of dividends. The Deputy Governor has already pointed out that banks can now apply Bank of Uganda to pay dividends. It is important to note that the measure itself was very successful during the pandemic period because it enabled banks to build very strong capital buffers against losses. For example, the core capital ratio increased from 20 to about 24% on aggregate during the period between April 2020 to April 2022. Nevertheless, as banks apply to pay dividends, Bank of Uganda will be mindful of the need for the same banks to continue to hold prudent capital buffers given the inflationary pressures that were ably explained in the monetary policy statement. And the payment of those dividends will still be subject to Bank of Uganda approval, taking into account whether the applying banks are in compliance with the capital requirements, especially the capital buffers which we implemented last year. And secondly, their compliance with the Basel II requirements, and also thirdly, the prevailing macroeconomic conditions. Thank you very much.
Okay, thank you, Robert. Next, we have Ali Twaha of New Vision.
Yes, good afternoon. Can you hear me? Let me first get a confirmation.
Yes, we can.
Yes, we can hear you.
Yes, thank you, DG, for the presentation. I came in a bit late, but on the issue of the shilling, the depreciation of in March especially, I wanted to know the effect it has had on, especially on the sales side from your intervention. What has been the effect on the reserves currently? Just give us an update on the reserves, how we are standing. And also the issue of dividend. Did I get it clear that you've lifted the restriction on withholding dividend on the supervised financial institutions? Just a brief clarification, because the line was breaking. Yes, thank you.
Okay, you said you are Twaha? Ali.
Please.
Okay, Ali, thank you so much for your question. Let me first start with the shilling depreciation before I get to its impact on the reserves. I will first of all try to explain to you what is causing the current depreciation and what have we been doing as a central bank. I think the causes of the current depreciation are largely linked to two factors. One, prior to the recent depreciation pressures, the currency had been very, very stable. It had been stable largely on account of the following. Our coffee exports were doing very well, and I think are still doing well. And then also we had the increased the increased presence of the offshore players in our domestic securities market because they were taking advantage of the interest rate differential, given the fact that interest rates in advanced economies were much, much lower compared to Uganda. So they were looking for a return on the investment. And then, of course, also we had strong inflows in terms of the remittances into our country. And then also we had received balance of payment support earlier on from some of our international financial partners who were assisting us to deal with the recovery occasioned by COVID. That is from the IMF and other international financial institutions. That money came in. And then most importantly, following the signing of the final investment decision to deal with the oil production. Significant confidence was actually was triggered in the country. Not, of course, forgetting the fact that even the way Bank of Uganda conducts its monetary policy, it was very prudent. So a combination of those factors led to the stability of the shilling. Now, what was then happening was that following the inflationary developments in the advanced economies, you're aware that inflation in countries like the US, the UK, are now just getting into about 10%. I think the US is about 9, the UK is about 8, in the Eurozone is about 7.5, if I get my numbers correct. Now, what the central banks there are doing is they're also tightening their own monetary policy by raising their policy rates. And as a result, the portfolio flows that had come here to seek for a return are now beginning to weigh that is the return on the investment in the frontier markets such as Uganda, is that return still enough for us to continue investing in this market? So following the recent increases in the policy rate by the Fed and the other central banks in advanced economies, we see that some of the portfolio players are now considering whether to leave the country or not. So as a result, they have been buying significant amount of forex from the market in preparation for the decision that they want to take. So that has been exerting pressure on the FX market. But also beyond that, you are aware that the import prices themselves have risen. Just take just take the case of the oil imports. Prior, sometime towards the end of last year, a barrel of oil was costing about $90 or so. Now, following the Russia-Ukraine conflict, the cost of a barrel went somewhere close to $130. Of course, it's now come down to about north of $100 a barrel. So what that means is that for the same quantity of oil that you're importing, you require more dollars to import that same quantity of oil. Now, that's just only an example of oil. But since we're experiencing global inflation, it means that all the prices of imported goods into Uganda have increased. So it means that we therefore have to pay more for the same quantity of goods. So all this is exerting additional demand to the forex market. And therefore, with the increased demand for the same quantity of goods in the market, and the supply side response is a bit limited, it means that the currency has come under pressure because of the increased demand, and that's why you have seen it depreciate. But the role of Bank of Uganda in all this is to ensure that the currency depreciates in a smooth manner. You might recall that around the end of March, the currency was trading anywhere between 3,520, 3,540. And as at yesterday, it was shy of 3,800. I don't know what is today, but it might have appreciated. This is what I do understand. So what we did there to allow the movement from 3,520 to where it was yesterday, shy of 3,800, we had to intervene in the market to avoid volatility, so that we don't have a haphazard depreciation of the unit. So the aim here is to ensure a smooth evolution in the exchange rate rather than something haphazard, but without trying to reverse the trend in the direction of the currency. So that is what I can say. Now, of course, as we intervene, we use our reserves, the reserves that we had accumulated at a time when we had strong inflows. Remember, I was telling you that the currency was stable, tending towards an appreciation. So we were buying significant amount of our reserves at that time as well. We were buying the currency from the foreign exchange market to build our reserves. So it's now part of those reserves that we're using to smooth out the movement. So we smooth out the movement both on the appreciation side and on the depreciation side. So if you talk about losing reserves, we lost some reserves as a result of smoothing it out. But also, these are the reserves were accumulated earlier on. So I think that addresses the question on the recent depreciation, unless I've missed out something. Now, on the dividends, I think Robert has been very, very clear that that while we have lifted the restrictions on the payment of dividends, there are certain conditions that you have to meet to be able to pay out those dividends. Because we don't want a situation where you pay out the dividends today and then tomorrow a supervised financial institution has got liquidity challenges again. So there are some conditions to ensure that your payment takes into account your future assessment of the risks that you are likely to undertake, and also the capital that you will have left after you have paid out the dividends. But maybe Robert can say more on that. And of course, also we're mindful of the macroeconomic conditions that we are operating in right now in making sure that the dividends payment do not exacerbate it.
Mr. Aditwa, we addressed this question, so apologies if the line wasn't clear. But as the Deputy Governor has pointed out, it is indeed correct that Bank of Uganda has lifted the restriction on payment of dividends by SFIs, and this took effect on 31st March 2022. However, payment of dividends will be subject to certain conditions. First, that supervised institutions that wish to pay dividends must submit a report that clearly points out that they are able to withstand any projected risks, including a very strong macroeconomic forecast of the risks that they may face and the ability to absorb any losses from those risks from their capital, and also the ability to meet the ongoing capital requirements, including the capital buffers. And we have been, on our part, engaging the supervised financial institutions in light of the emerging inflationary pressures and the soft economic growth to ensure that they continue to keep prudent capital buffers to withstand those shocks. And so, whereas we have restricted, we had restricted the payment of dividends, and whereas it has been lifted, we also expect financial institutions to be prudent in their applications to pay these dividends, mindful of the emerging risks. Thank you.
Okay, thank you. Thank you, Robert. We have two more questions from Sam Setumba via the chat. And this question is, does continuation of our development trajectory make sense now when we don't know when Ukraine-Russia war will end, or some slowdown might be of essence? That's one. You've got the question?
Could you repeat it?
This is Sam Setumba, and he wants to know, does continuation of our development trajectory make sense now when we don't know when Ukraine-Russia war will end, or some slowdown might be of essence? Then two, debt instruments were issued recently, this week by Bank of Uganda. At the end of the financial year, can we say all is well with government revenue?
Okay, thank you, Sam. I will mention something briefly, and then Adam will add in the details. When you talk about the development trajectory, I want to guess you are meaning the growth trajectory. And if I'm right, then I think certainly we have mentioned in the statement that we see growth softening. It's not as strong as we had forecasted to be. And the reason we attributed this to was the tightening of the domestic conditions on account of a tighter monetary policy conditions, because we see domestic inflation picking up, and the domestic inflation is partly, explained by what is happening in the Russia-Ukraine, zone. So it is true that growth is going to soften going forward, and we only hope to get back to our 6 to 7% maybe around 2025, 2026. But as of now, we are projecting growth in 2022 to be 4.5 to 5%, which is something much weaker than 5.5 and 6% that we had earlier projected. Now, as we also tighten the monetary policy conditions, this is certainly going to have an impact on the demand for credit, and it's going to make it a little bit tighter. So we think that on the account of the tightened monetary policy conditions, growth is going to soften further. But the most important thing is to avoid inflationary expectations entrenching. We don't want inflationary expectations to entrench, into the public. And like we said earlier on, we believe that this is going to be temporary. So once we get hold of inflation and we anchor it, then we can address the growth issues by maybe relaxing the monetary policy conditions once we have ensured that inflationary expectations are now well anchored. So you're right, in the near term, growth will be affected by tighter monetary policy conditions and the global developments. And we hope that even if we do not know when the Russia-Ukraine crisis is going to end, we think that by anchoring inflationary conditions, we are going to support growth in the medium term, notwithstanding what's happening in the Russia-Ukraine. We need to do something on our own as a country without waiting for the Russia-Ukraine crisis to end. Because if you sit down, wait for it to end, I mean, you'll be much, much, much worse off than taking no action. Now, you also asked a question on the, I guess you are referring to the 1.45 trillion that government borrowed from the domestic markets yesterday. It does not speak to anything. This was something that had been planned for. The government had hoped to borrow this money externally, but because of some delays in concluding the borrowing, it was decided that we borrow domestically. And indeed, we had a private placement in the market, and government was able to raise the full amount of money that they had intended to borrow. But it does not mean to say that government finances are in disarray, because what they borrowed yesterday was supposed to have been borrowed externally, but they have only substituted the sources of borrowing from external to domestic. But the revenues that are financing the budget are projected to be as they had been planned. Now, what has happened here is the substitution of external borrowing for internal borrowing. So I think on that note, even we should commend our capacity to be able to handle such a transaction, which means that our domestic financial markets are really getting deep, and we can sustain government and private sector demands for credit. Maybe Adam, you want to add something to that?
Thank you, DG. I think on what Sam was raising about development trajectory, I think we have to recognize that by the time the Ukraine-Russia crisis came on board, we are just basically emerging from the pandemic. So it was really adding an insult to an injury. But I think now the pandemic is somehow, the effect of the pandemic is somehow dying off. And now we we are dealing with the, this additional aspect of the crisis. And as we all know that a part of the Ukraine and Russia crisis, the way it is impacting us, is really through the global economy. Because our direct trade link and financial link with Ukraine are minimal. But the question I'm trying to emphasize is basically it came in when we are just re-emerging from the pandemic. So therefore the effect of Ukraine war is really on the Uganda's growth is mild if you take off the fact that actually we already the pandemic effect. So therefore I don't think really it will derail the economic development per se. It is only, as we say, it is only a temporary hold in terms of the gross numbers. Now, the other question was about revenue and expenditure. Obviously, once you have a revision in growth outlook, it has an impact on expected tax revenues because tax comes from economic activity. If economic activities slacken, automatically revenue can also be impacted. So the question therefore would be rebalancing. And I think the budget, the way it's done, it is flexible. In the event that expected revenue is not forthcoming, there are always adjustments within the budget to make sure that actually remain within the same priority. And on that, we also acknowledge that the aspect of expenditure prioritization, including expenditure on agriculture productivity through the, say, parish models and other activities, will really support economic growth going forward, and also partly support the aspect we talked about earlier on, that once these are implemented, then actually even the food crop inflation we are seeing will start really declining in the year ahead. So overall, I think I don't think this is a crisis to derail economic development per se. As we said, this is a temporal hold. Probably, I think growth will start emerging as soon as the economy stabilizes. Mainly so the fact that the pandemic, if we don't get another round of the virus. Thank you.
Thank you, Dr. Mabune. That marks the end of our Q&A. Thank you very much, DG, and your team for this Q&A session. Thank you.